The FOMC meeting. Patricia Louis joins me now with the details. So Trish, more weakness to come for the dollar, at least for the immediate future, correct?
Yes, certainly. So traders are expecting this greenback could continue to be under pressure for at least the next 24, if not 48 hours. Now, the dollar index yesterday fell the most in 2 weeks, skidded about the 1.2% against the majors. The biggest catalyst was interest rate expectations. Markets are rolling back their expectations on the Fed rate hike by year, and expecting that the FOMC meeting for the next couple of days, the Fed will definitely send a very strong signal that the rate hikes are much further down the line, and they will not want to squash any green shoots yet. So the Fed implied futures have already rolled back the rate hike expectations. The market is now looking at only a 40% chance of a Fed hike by year end. Now, just a week ago, they were looking at 50% chance of a Fed hike by year end. Now, weighing on the US dollar was also comments from the Eurozone. ECB official Weber actually said last night that the scope for any further interest rate cuts in the Eurozone has been used up. Now, market feels that this means that the spread of 1%, currently the Eurozone rates are 1% and the US rates are as low as 0. So this 1% yield premium over US rates will remain intact, at least for the foreseeable future. And they expect that this actually will continue to act against the greenback. The dollar losses are expected to continue for at least 24 hours, and they expect that the high yielders and the commodity currencies, Aussie, Kiwi and Canadian dollar, will be the biggest winners at this stage.
It does sound like there'll be some risk of a whiplash from all of this.
Yeah, well, it definitely so. Market says that the biggest risk right now is also, again, to do with the Fed FOMC, and that's the quantitative easing. Market's not sure whether the Fed will expand, maintain, or roll back the quantitative easing, and this could pose a lot of confusion right after the Fed statement, which is going to be out on Thursday. There's also the Treasury auctions. Now, despite the record size of Treasury auction this week of 104 billion, so far the reception has been pretty good. And the most closely watched part, which is the foreign central banks part, that came in much better than expected. Yesterday's two-day auction, traders are saying, is the strongest reception since September 2007. Foreign central banks' reception was 69%, almost the biggest in 6 years. So this not only eases concerns about foreign demand for U.S. treasuries, it also supports the dollar, and this could actually throw a bit of a wild card to what's happening on the rate expectations now at the moment. So lots of stuff for traders to digest there,
Definitely. Trish, thanks for that.